Welcome back to Switzer on Sky News Money. My next guest is Simon Conn, a Senior Portfolio Manager from Investors Mutual. He's here to share his views on the world and tell us how his fund is investing right now. Simon, welcome to the show.
Thanks, Marty.
So
Thanks for having me.
Very welcome. So we've obviously had a good run on the market post-Brexit. I think a lot of people have been surprised with the result. But, a lot of positives coming out in terms of US earnings season, in terms of, I guess, accommodating monetary policy around the world. Data's been, reasonable. What's your views on what's happening in global financial markets at the moment?
Yeah, look, it's always, there's lots of noise going on and we've seen lots of volatility. I think we've been saying that for some time. But, I think the Australian underlying economy is okay, and it's in a grind. It's a low growth environment. Probably confirmed by the CPI numbers, there's not getting high top-line growth. Yeah. But I think corporate Australia, is in reasonable health, and so there is growth out there. The question before we were talking is, with low rates, people are willing to pay much higher prices for earnings certainty, and particularly for yield. Yeah, absolutely. And so, in terms of the inflation number, what are you expecting to happen next week with the Reserve Bank? Are you in the cut camp or the stay on hold camp? Look, at the way they've been talking, I think there's always a chance that they cut again. I think they're very concerned about the currency because I think the big positive for the domestic economy over the last few years has been the low Australian dollar, and I think they get concerned every time the currency starts to edge up above 75 cents. We see stories on the front page of the Financial Review on the weekend talking about Australia's own version of QE. And I think what they've done quite cleverly is through macroprudential measures, try and keep a lid on the housing market growth. Yeah. Certainly the banks are talking. They're getting squeezed on the margin. So maybe if they do cut, they won't pass on the full cut. That's definitely seen to wash through in the investor home loan market. That's right. So the lending rates there. Yeah. And what they've done with the Chinese. And look, we did see. It became an incredible rapid growth in the apartment market, and it really didn't filter through to the broader housing market to the same extent. Yeah. And so I think they'd be happy if that was to continue to be okay, whilst tapping that that high-rise market. So earnings season's, I guess it's basically upon us now. And, it's imminent. You've obviously got a lot on your plate at the moment. In terms of the theme that's going to come out, are you expecting this to be a sort of a cost-out earnings season again, or are you expecting to see revenue growth from some of the major players? Yeah, look, certainly as I was saying before, I think it's really going to be a low growth environment, so we're not seeing high top line growth. Okay, so that means a cost out story. It has to be. Look, the thing that we've been thinking, positioning out in the portfolios for some time, is looking for companies that can either take costs out through cost initiatives. So Pact Group, we've talked about that one before. Yeah. Companies that can make acquisitions and in an accretive sense. So Main Pharma, has been a really good performer for us recently, and they did a huge acquisition which is very synergistic. Companies that are taking market share, or companies that can just run their businesses more efficiently. So it has to be company specific, and to really try and get growth, because there is it's not a high growth, highly cyclical environment. Yeah. And what are some of the companies that you think sort of meet those criteria that you're investing in at the moment or invested in? Yeah, look, GWA is a company we've followed for many years, and we've got a reasonable position. GWA. GWA. Yeah. So they own the Chroma Dorf brands. Okay. Been through quite a big restructuring over the last 3 to 4 years, but they're purely an importer and distributor of product and a brand developer. So their pure focus is on new product development. They've just come to market with a new rimless toilet, which has seen their increased retail facings in the market. Everyone needs a toilet. Yeah, absolutely, and the things wear out. So there's a good replacement and repair market there. Yeah. I think the management previously were distracted by the internal ructions and divestments that they were doing, so they suspended the dividend for a period of time. But it's a really strong core business. Chroma, they've led the world in technology in terms of dual flush and water saving technology, and now again with this rimless product, they prove they are innovators and leaders globally in the set. Obviously, largely exposed to the Australian market. But there is, new management there under Tim Salt, and he's really refocusing in terms of driving a sales and marketing focus. So, is there an income component to that? Yeah, look, that stock pays about a 7%, 6.5%, 7% fully franked yield. Okay. It's on a P of 12 or 13 times. Yield. So I think it sort of gets caught up in the cyclical stocks, and because it's been through a restructuring, people are a bit confused about it. But very solid business, produces really good cash flow. We think new management, I think they've got scope for cost outs. Potentially, maybe there's another divestment to come of their locked business. But their core business around Chroma, Dorf, Fowler is just a really strong franchise in Australia. Another stock we like is Integral Diagnostics.
Okay.
Listed just last year, got caught up in the uncertainty around Medicare funding and the government's funding of healthcare. That uncertainty seems to have abated. We've certainly seen many other stocks, re-rate on the back of that. But on a sort of P of 13.5, 14 times, yielding 5% fully franked. It's a pretty resilient business, not necessarily highest growth, but there is still fragmentation in the market, and so there's acquisition opportunities, and we think they can, grow their business through time, and certainly it's not for price for that, those sort of multiples. So, even though things have moved up, you can still find pockets of value in the market, and that's what, I suppose that's our job, to look through it and try and find it.
And so what are the criteria that when you're assessing a company and the management of that company and deciding whether or not you'll make an investment in them, how do you sort of, what's the criteria that you use to sort of, determine whether or not this investment is right for your portfolio?
Yeah, look, we've got a very stringent investment mantra that we apply. So we look for companies that have a strong recurring income stream. So PACT, which I mentioned before, Caroma, the replacement cycle. We look for good management, recurring earnings, good balance sheets, and businesses that are reasonably priced. And they're the mantras and the criteria we apply looking for stocks across the market.
And is that applied to all the different strategies that you run at IML?
Absolutely.
You're looking for that common theme, whether it's small cap, large cap?
Absolutely. Across all the portfolio suites of products, we look for those characteristics. What typically means we don't invest in the contractors, and we have quite a low exposure to the resources. Obviously, the resource sector is pretty volatile. It's had a good run just recently. I think that's sort of helped the confidence generally across the economy. But there's stocks that we don't invest in largely.
So obviously, as we mentioned before, the market's had a good run in the last month. Post Brexit, Brexit was supposed to result in, I guess, markets going the other way, but they've done the opposite, and most asset classes and most markets around the world have risen in value. Does that concern you? And do you think that we can expect similar growth moving forward?
Look, I think as you've alluded to, lower rates have led to a re-rating in terms of the multiples that people are willing to apply. So we've seen bond investors moving into equity markets. We've seen retirees, people who are traditionally looking for bonds or cash for income, moving into the equity markets. So non-traditional owners. When we've seen prices bid up, as you mentioned. Some of the larger infrastructure stocks, Sydney airports and the like, Transurban, those companies have moved up significantly in price. And so that re-rating is massively greater than what we've seen in terms of earnings growth. So it's a big re-rating. So I think investors have to generally be fairly cautious across the market and look for those stocks that I think are still trading at reasonable prices, and try and identify companies where they can grow their earnings over the next 2 to 3 years through those initiatives we talked about. So maybe acquisitions, cost outs, or taking market share. And that, I think, that will see a share price trade higher through time, and also collecting a reasonable dividend. But generally, I think you've got to be cautious on a lot of stocks that have had big re-ratings.
Headwinds that the market's possibly facing at the moment that is keeping you awake at night?
Look,
hopefully not too late.
Look, obviously, we worry about most things, but Australia, a period of unbroken economic growth over, I think, 24 years now. So you always worry about what's on the horizon. Look, as we see it at the moment, and the feedback we're getting from corporates is that the economy is reasonably well positioned. I think, unlike a lot of other countries around the world, our population's growing. The currency, as I said, gives you a bit of a competitive, gives Australia a competitive advantage. Tourism's growing. We're still in one of the fastest growing parts of the world, in Asia. So, whether that's for Blackmores or the Bellamy's, or they're looking for other companies in the consumer-facing area, tourism, education. So there's still positives for the Australian economy. And I think, we've got a free floating exchange rate, good Reserve Bank, and, control over our monetary policy. So, unlike a lot of other places in the world...
still, don't we?
That's right. So, look, there's positives to the Australian outlook. I don't think it's diabolic. I just think it's a low growth, and people just have to adjust their horizons and their expectations around
Simon, thanks for your time.
Thanks, Marty.
After the break, we'll chat with Rudy, Philippek Van Dyke and James Suter from K2 Asset Management on US earnings. Don't go away.